What we are witnessing in the silver market is not normal anymore. This is not speculation. This is not sentiment. This is a structural breakdown between two incompatible systems, and one of them is collapsing right now. On one side, there is paper, contracts, leverage, synthetic exposure. On the other side, there is metal, physical, strategic, scarce. For decades, these two systems coexisted peacefully. The paper market set the price. The physical market followed. That arrangement is ending. The mechanism behind this collapse is simple. Paper silver can be created infinitely. A futures contract does not require actual metal. An option does not require delivery. A derivative does not require settlement. The system was designed this way. It provided liquidity, it enabled price discovery, it removed the constraints of physical supply. But that design contained a fatal flaw. It assumed paper and physical would remain interchangeable forever. It assumed confidence would never break. It assumed no one would demand delivery in quantities large enough to expose the illusion. That assumption is being tested right now. Industrial demand for silver has been rising for years. Solar panels require it. Electric vehicles need it. Defense systems depend on it. Advanced electronics cannot function without it. These are not optional uses. They are structural requirements, and they cannot be substituted. The quantities involved are staggering. A single electric vehicle contains roughly 1 kilogram of silver in its electrical systems. Solar panels use approximately 20 grams per panel. Military applications consume even more. Missile guidance systems, radar equipment, communication devices. Each unit requires silver in quantities that add up across global production. When you multiply these requirements by projected growth rates, the math becomes uncomfortable. Electric vehicle sales are expected to reach 30 million units annually by 2030. That alone represents 30,000 metric tons of silver demand. Add solar installation targets. Add defense spending increases. Add consumer electronics growth. The total exceeds current mining output by a significant margin. At the same time, something else happened. Multiple governments reclassified silver as a strategic material. This was not symbolic. This was policy. When a resource becomes strategic, access becomes a national priority. Stockpiling begins. Export controls are considered. Trade agreements are rewritten. The market stops being financial. It becomes political. This shift is already happening, not in theory, in practice. Several nations have increased their silver purchases dramatically in recent months, not through public announcements, quietly, through sovereign wealth funds, through state-owned enterprises, through intermediaries designed to avoid detection. China has been particularly active. State-owned refineries have increased production capacity. Import quotas have been adjusted. Strategic reserve targets have been raised. These are not market decisions. These are government directives executed through economic channels. India, traditionally a major consumer, has shifted from retail demand to industrial stockpiling. The pattern is visible in trade data. Imports are rising, but jewelry demand is flat. The difference is going somewhere, into warehouses, into industrial reserves, into long-term storage. But the disruption is coming anyway. Because while governments have been accumulating physical metal, the paper market continued operating as if nothing changed. Shorts were placed, leverage was applied, positions were rolled forward. The assumption remained, delivery would never be demanded. That assumption is breaking now. Reports from refineries show physical premiums rising sharply, not small increases, sustained jumps. In some Asian markets, premiums have reached 8 to 12% above spot prices. In European industrial centers, delays for 1,000-ounce bars have extended to 8 weeks. This is not volatility. This is a signal. Physical availability is tightening faster than paper markets are pricing in. Logistics are worsening too. Silver does not teleport from mine to vault. It must be transported, secured, insured, stored. When demand surges, these systems do not scale instantly. Bottlenecks form, delivery timelines extend, contracts promising 2-week settlement now take 6 weeks, sometimes longer. The concentration of refining capacity makes this worse. Switzerland processes a significant portion of global silver supply. South Africa handles much of the mining output. When transportation costs rise or geopolitical tensions increase, these choke points become critical vulnerabilities. A single disruption at a major refinery can cascade through the entire supply chain. This creates a feedback loop. As physical delivery becomes unreliable, buyers change behavior. They stop trusting paper. They demand physical settlement. They increase premiums. They hoard inventory. This strains the system further, which increases delays, which increases distrust, which increases physical demand. The loop accelerates. Now, something else is happening. Liquidity is draining from the entire financial system. Stocks are falling. Bonds are volatile. Currencies are weakening. Digital assets are collapsing. This is synchronized movement. When liquidity contracts across all markets simultaneously, it signals system-wide stress. Capital becomes defensive. Risk appetite disappears. Everything moves together. In this environment, leverage becomes a liability. Positions profitable on paper suddenly face margin calls. Trades that looked hedged become exposed. Strategies relying on liquidity find none. The paper market, designed to absorb volatility, begins amplifying it instead. Here is where the real danger emerges. If physical silver becomes unavailable at quoted paper prices, the entire pricing mechanism collapses. Futures contracts promising delivery become worthless if delivery cannot occur. Options lose meaning if exercise is impossible. The system depends on belief, the belief that paper and physical are equivalent. When that belief breaks, the system breaks with it. This is not prediction. This is description. This is what happens when structural imbalances reach their limit. History provides clear examples. In 1980, the Hunt brothers attempted to corner silver. They accumulated physical metal. They demanded delivery on futures contracts. The system responded by changing the rules. Margin requirements were raised. Position limits were imposed. The exchange intervened to prevent default. The system survived, but only because intervention was possible. What made the Hunt situation unique was its visibility. Everyone knew what was happening. The accumulation was public. The strategy was obvious. This allowed regulators to respond before systemic breakdown occurred. Rules were changed mid-game. New position limits were implemented overnight. Silver Thursday happened on March 27, 1980. Prices collapsed from $50 to $11 in days. The corner failed, but the system survived because the threat was visible and centralized. Today is different. The accumulation is not coming from speculators. It is coming from governments, multiple governments, acting independently but with similar objectives. Intervention is not an option when buyers are sovereign entities acting on strategic imperatives. The rules cannot simply be changed when national security is involved. There is no single position to unwind, no single actor to target. The pressure is distributed and systemic. Another parallel exists in the gold market during the 1960s. The London Gold Pool was created to suppress gold prices. Physical reserves were sold into the market. The goal was maintaining confidence in the dollar. For years, it worked, until it did not. By 1968, physical demand overwhelmed the pool's ability to supply. The system collapsed. Gold was repriced. The dollar lost its gold backing. The entire monetary framework shifted, but the scale was manageable. The gold market affected central banks and governments primarily. Retail participation was limited. Industrial demand was minimal. The silver market today faces similar dynamics. Paper supply suppressing prices, while physical supply is absorbed. But the scale is different. The gold market in 1968 was large but contained. The silver market today is embedded in critical infrastructure, in industrial supply chains, in strategic stockpiles. The consequences of breakdown are far wider. When gold's link to the dollar broke, it affected monetary policy. When silver's paper market breaks, it affects production of essential technologies. A third example comes from the copper market in 1996. A single trader at Sumitomo Corporation accumulated massive positions. For years, he controlled prices through leverage. The scheme worked until physical delivery was demanded. When the position unwound, copper prices collapsed 50% in weeks. Sumitomo lost $2.6 billion. The trader went to prison. But the lesson was clear. Paper control only works until physical reality asserts itself. The pattern repeats across different commodities and different decades. Paper leverage creates artificial pricing. Physical scarcity eventually forces correction. The transition is never smooth. It is always violent, and it always catches the majority unprepared. Now let us map this pattern onto today's silver market. We are witnessing the same stages unfold in real time. Stage 1 was the buildup. For years, silver was priced as if supply were infinite. Derivatives expanded, leverage increased, short positions accumulated. The paper market grew far larger than the physical market. No one questioned this. Confidence was absolute. The ratio of paper claims to physical metal reached levels that would be impossible to settle if delivery were demanded, but delivery was never demanded in sufficient size, so the structure held. Stage 2 was the divergence. Industrial demand began rising faster than supply. Strategic buyers entered the market. Physical premiums started increasing, but paper prices did not reflect this. The gap between paper and physical widened. Most participants ignored it. They assumed convergence would occur naturally. They believed arbitrage would close the gap. But arbitrage requires the ability to deliver physical metal, and that ability was declining without acknowledgement. Stage 3 is the stress. We are here now. Physical delivery is becoming difficult. Premiums are spiking. Liquidity is thinning. Margin pressure is increasing. The system is showing strain, but it has not broken yet. Participants still believe the mechanism will hold. They believe this is temporary volatility. They believe normalcy will return. This belief is what allows the system to continue functioning even as its foundation erodes. Stage 4 will be the break. This has not happened yet, but the signals are accelerating. When it comes, it will be sudden. A delivery failure, a default, a margin crisis. Something will trigger recognition that the system cannot function as designed. Confidence will collapse. The repricing will be immediate and severe. What signals should we watch? First, physical premiums relative to spot prices. When premiums exceed 10 to 15%, it indicates severe physical tightness. We are approaching that level now in certain regions. Some industrial buyers are already paying premiums above this threshold quietly. This information does not appear in mainstream price quotes, but it is visible in private procurement contracts. Second, delivery delays on futures contracts. Normal settlement is 2 to 3 weeks. When delays extend beyond 6 weeks consistently, it signals systemic strain. We are seeing this in multiple markets already. Anecdotal reports from refineries suggest some orders are being quoted at 10 to 12-week delivery windows. This is unprecedented outside of pandemic disruption periods. Third, changes in exchange rules. When exchanges suddenly modify margin requirements or position limits, it indicates stress they are trying to contain. Several exchanges have made quiet adjustments in recent months. These changes are often framed as routine risk management updates, but their timing and frequency suggest reactive rather than proactive adjustments. Fourth, institutional withdrawal from market making. When large banks reduce their derivative exposure, it signals risk they no longer want to carry. Regulatory filings show this is happening now. Several major institutions have reduced their silver derivative books by 20 to 30% over the past year. This withdrawal reduces liquidity exactly when markets need it most. Fifth, Sovereign buying patterns. When central banks or government entities increase purchases without public announcement, it indicates strategic positioning. Trade data suggests this is accelerating. Import statistics show increases that exceed reported industrial consumption growth. The difference implies stockpiling at levels not seen in decades. Sixth, correlation breakdown between silver and other assets. When silver starts moving independently of traditional correlations, it indicates a fundamental shift in market structure. This decoupling is already visible. Silver historically moved with gold at a consistent ratio. That ratio is now breaking down. Silver is also decorrelating from industrial metals like copper. This suggests a category shift is occurring in real time. These signals are not random. They are connected. They are symptoms of a system approaching its limit, and systems approaching limits do not give advance warning. They simply fail. Two scenarios are now possible. In scenario 1, the system adapts. Exchanges modify contract terms. Delivery requirements are loosened. Cash settlement becomes mandatory. The paper market continues functioning, but with reduced connection to physical reality. This is the managed decline scenario. It is orderly, but it destroys confidence in pricing mechanisms. Once participants realize that contracts will not deliver physical metal, the entire purpose of the futures market disappears. Hedging becomes impossible. Price discovery becomes meaningless. The market becomes a betting pool disconnected from underlying assets. In scenario 2, the system breaks. A major delivery default occurs. Contracts are not honored. Litigation begins. Markets freeze. Emergency measures are implemented. The paper market ceases functioning temporarily. When it reopens, the structure is fundamentally different. This is the disorderly transition scenario. It is chaotic, but it forces honest price discovery. The repricing will be severe, but it will reflect actual supply and demand rather than leveraged positioning. Both scenarios lead to the same conclusion. The era of paper leverage controlling strategic material prices is ending. Physical control will determine value. Scarcity will be priced accurately. The transition may be managed or it may be chaotic, but the direction is set. What does this mean practically? First, understand what you actually own. A futures contract is a promise of delivery. An ETF is a claim on a pool. Physical metal is the metal itself. In a functioning system, these are equivalent. In a stressed system, they are not. The difference becomes critical when settlement is challenged. Second, recognize that paper prices may not reflect physical availability. A quoted price means nothing if transaction cannot occur. Liquidity is assumed until it disappears. When it disappears, price becomes meaningless. The bid-ask spread can widen instantly from pennies to dollars when liquidity drains. Third, accept that traditional risk management may not work. Hedging assumes liquid markets. Stop losses assume execution is possible. Diversification assumes assets remain accessible. Under stress, these assumptions fail simultaneously. Positions that appear hedged become directional. Stop orders do not execute. Diversification fails when correlations converge to one. Fourth, prepare for discontinuous moves. Markets do not gradually adjust during structural transitions. They gap violently. Positions that were safe become catastrophic. Timing becomes impossible. The gap from functioning market to frozen market can occur overnight without warning. Fifth, understand that intervention may not help you. When authorities intervene to stabilize markets, they protect the system, not individual participants. Your position may be sacrificed to preserve overall stability. Contract terms can be modified retroactively. Settlement can be forced in cash rather than physical. Exchanges have broad emergency powers that override individual contract rights. Sixth, realize that this extends beyond silver. If paper markets cannot price one strategic material accurately, what does it mean for others? Copper, lithium, rare earths, energy. The implications cascade across the entire commodity complex. Every market built on paper leverage faces similar vulnerabilities when physical scarcity emerges. The silver market is not just about silver. It is about the fundamental architecture of modern finance. That architecture is built on abstraction, on leverage, on the assumption that paper claims and physical assets are interchangeable. When that assumption fails in one market, it raises questions about all markets. This is why what happens in silver matters far beyond silver itself. It is a test case, a leading indicator, a warning sign. If the paper system cannot handle stress in a relatively small market like silver, what happens when stress hits larger markets? The answer is not comforting, but it is predictable. The same pattern will repeat. Paper leverage will meet physical reality. Confidence will break. Repricing will occur. The transition will be disruptive. This is not conspiracy. This is not manipulation. This is structural mechanics. When two incompatible systems collide, the weaker one breaks. Paper cannot create metal that does not exist. Leverage cannot overcome scarcity. Synthetic exposure cannot replace physical control. The silver market is teaching this lesson right now. Those who understand it will position accordingly. Those who do not will discover the lesson when it is too late to act. We are watching a transition in real time, from a financial system built on paper promises to a system built on physical reality, from price discovery through leverage to price discovery through scarcity, from markets controlled by trading volume to markets controlled by strategic possession. This transition is not coming. It is here. The mechanisms are in motion. The outcome is determined. Only timing remains uncertain, and timing is controlled by forces larger than any individual participant. Forces that do not care about paper prices. Forces that only care about strategic control. The paper market will not announce its failure. It will simply stop functioning. Contracts will not settle. Delivery will not occur. Prices will gap. The system will freeze. And when it restarts, the rules will be different. This is educational analysis, not financial advice, not investment guidance, just observation of a pattern that repeats whenever paper promises collide with physical scarcity. The pattern is documented. The mechanism is visible. The outcome is inevitable. The silver market is providing the warning. Whether anyone listens is another matter, but the warning is there, clear, urgent, undeniable, for those willing to see it.